All right, so I'm going to make a series of hopefully short review sessions like this for the next assessment. First thing I'm going to talk about is income statements, and I'll just let you know what I want you to know about income statements. First of all, an income statement is it measures a level of volume of business for a certain period of time, right? In this case, it's a month. It could be for a quarter, which is a 3-month run, or the entire year. But it says between this point and this point, how much business did we do? Right? I say that because I don't want you to think it equates into cash. We've talked about many times that the revenue produced during that volume of business, time period, we might not get that cash until the next month or even 6 weeks later. Same thing, the expenses we talk about on an income statement that are incurred during that time period, we might not actually pay those expenses for a couple months, or well, usually it's within a month, frankly. But the point being that the income statement just tells me how busy were we, right, in producing revenue, and how much in costs and expenses we may have created in order to make that money. It's not about we got this much cash and this much cash left the building. It's not about that, because we know that not all revenue is in cash form. We wait for a lot of our cash. We wait to pay a lot of our expenses. There you go. Let's talk about this first block of information, our sales, right? Each of these items is called a revenue stream, right? There could be many different revenue streams, ways that we make money, different aspects of the business that bring in money. In this case, food is one revenue stream, beverage is another revenue stream. This is a independently owned, freestanding restaurant. We add all that up, that's our revenue. That much we know. We do know that revenue is price times volume. What was the price of the item we sold, and how many of those things did we sell? We estimate this in the restaurant world by calling it a check average, right? On average, how much do people spend when they come here? If I know that, and I know how many people showed up, I know how much revenue I made, right? Price times volume. Great. And so that's our total revenue. That's how much revenue was created during this month. It's not about cash, right? It's not about actual income. I'm waiting for some of that money at any given time. But this is how busy we were, $85,000 busy in April. First block of information is our first type of cost or expense that we have to remove from that revenue to move towards to find out how well we did with profit. Cost of sales are the physical goods, right? The actual goods, the physical stuff that we purchase in order to turn it into something saleable and then mark it up and then sell it to the customer. And the difference between what we buy it for and what we sell it to the customer for is our profit. Right. So in this case, we had to buy food, right? We had to buy and then use $27,000 worth of food in order to produce $68,000 worth of revenue. And then the same thing with our beverages. So in this case, we purchased and went through a little over $31,000 worth of food and beverage in order to sell $85,000 worth of finished or produced or restaurant food and beverage. First block of expenses that are removed, and we have something called gross profit. Gross profit is exactly that. After I remove my cost of goods, I come to this gross profit level. Throughout an income statement, we have some blocks that are based on revenue. This is how much money is coming in. We have other line items that say this is how much money is going out, subtracted from the revenue. And then we have third type of line item that says this is basically where we stop after we have removed a block of expenses from our revenue and say, okay, how much money do I have left now that I've gone through that and done that? Our next block of expenses or costs is labor, because we have two prime costs. You see the words prime cost there. One prime cost is our cost of goods. Second block of expenses that are removed are our labor expenses. We have management. These are fixed costs. They never change. We have staff labor expenses. These are variable. They go up and down based on our volume of business. And then we have our total labor. This is how much I had to pay people in order to produce the food and beverage in order to sell it to the customer. We're skipping prime cost for now. So our second block of expenses and costs is labor. Our third block of costs and or expenses is our controllable expenses. These are the things the manager can control. We talked about this before, right? Our managers should be held responsible for some costs and expenses because that's what they make decisions about, but not others. Remember, the manager can make decisions on music and marketing and to a degree control the utilities and those sorts of things on a day-to-day basis. So those are the things that we say whether or not the manager did a good job or not based on this. So we take our gross profit, right? Our gross profit is our revenue with our cost of goods sold already removed. Then we remove this block of costs from there, and we skip prime cost, and we remove this block of costs from there, and we have something called our controllable income. This is the income we have left over after every one of our controllable expenses has been removed. From a management level, this is where you're done. You're saying, look, I did my best. All the other expenses from this point down are for people who are at the owner level, at the board of directors level. You may be one of those at some point, but for now, you're probably going to be a manager. So anything below this is the responsibility of somebody in a higher position. Then we remove our next block of expenses. Those are our non-controllable expenses, meaning the manager can't control these. They are decisions made at a higher level, and they just sort of get put into place by owners, typically. Things like how much rent we're paying, the licenses and permits. There's nothing a manager can do to cut back on these expenses, right? The lease is the lease, the rent is the rent, the depreciation and amortization is just a function of accounting. So these are things that the manager shouldn't have to worry about. And after we remove those expenses, we call that the operating income. Remember, if I highlighted it in the left-hand column, it means it's neither a revenue block of information, nor is it an expense. It is where we are sort of just stopping along the way to say, after we have removed the most recent block of expenses or costs, how much do I have left now? How much do I have left now? How much do I have left now? This is how much we have left now. And then I take out my interest expense. How much do I have left now? I take out my taxes, which is in this case, you can see it's a percent of my income before taxes. How much do I have now? And that's my net income after all my revenue has been utilized to pay for the food that I had to buy and the beverage I had to buy, for the labor, for all these other non-controllable expenses and my controllable expenses, my interest expense, and I paid my taxes. This is how much I actually have left at the end of the day. So I would like you to know the difference between my revenue line items, my expense or cost line items, these net income, operating income, or profit line items. And then one more thing that has no mathematical value here. It's just a calculation that we are taking a look at about halfway down the income statement, saying, what are my prime costs? How much did I spend on prime costs? And if you remember, prime costs is just our total cost of sales plus our total labor. And it just sits there. It doesn't get added to anything. It doesn't get subtracted to anything. It's just one of those lines I take a look at, but it's not part of the subtraction that goes down with the other blocks of expense and cost. Cool. So that is what I would like you to know from that standpoint. The next little video is going to deal with vertical analysis. So come back for that one. Sound good?